Ladies and gentlemen, good day and welcome to the Q2 FY24 earnings conference call of Eveready Industries India Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Siddharth Rangnekar from CDR India. Thank you, and over to you, sir.
Thank you, Michelle. Good afternoon, everyone, and welcome to Eveready Industries India's Q2 and H1 FY24 earnings conference call. We have with us today Mr. Subramanian Saha, Managing Director, Mr. Vivek Agarwala, Chief Financial Officer. Before we commence, let me first share the standard disclaimer. Some of the statements made on today's call could be forward-looking in nature, and actual results could vary from these forward-looking statements. A detailed description in this regard is available in the press release, which has been circulated to you earlier and is also available on the stock exchange websites. I would now like to invite Mr. Saha to share his perspectives with you. Thank you, and over to you.
Thank you, Siddharth. Good afternoon, and it is our pleasure to welcome you all to our earnings call today. I will commence my remarks with some pointers on the developments during the quarter and progress made by us during this period. As you are aware, Eveready comprises of 3 distinct business segments, the first and the core category being that of dry cell batteries. Then we have our other traditional category of flashlights, and the recently initiated category of LED lighting and associated items. All these businesses rest on the 2 pillars of our company, brand and distribution. Majority of all businesses are run with brand Eveready, the premium portfolio with the brand Eveready Ultima, and the smaller part being run with PowerCell and Uniros brands. As indicated in our earlier calls, over the last 1 year or so, we have been engaging ourselves with making these 2 pillars stronger with a view to move to attractive growth in a sustainable manner. With this in view, lately we are spending much higher than the historic norms towards advertising and promotions. Ours is a consumer-facing company, and it is vital that we engage with them on an ongoing basis. I am pleased to advise that in every category that we are present, there is affinity and salience around the brand, and our investments with focused amounts is only going to solidify that bond. Apart from increasing spends, during the quarter, we overhauled our brand logo to the new Infinity Avatar with a transformed tagline of "Give me power, give me red." Consumer research formed the core of this revised architecture, and the results are pleasing. Similarly, in order to achieve this robust growth agenda across our 3 categories, we are in the process of a revamp of the distribution infrastructure in keeping with the requirements of the market. This entailed a pruning down of the overall distributor count to enhance efficiency in the higher tier areas, introduction of a super stockist network in replacement of many small dealers to access and service more effectively the remote areas. In doing so, we have met with some challenges over the last quarters in settling down with the right choice of channel partners and getting our internal ecosystem in complete alignment with the new architecture. We did expect some amount of disruption during the implementation of the new route to market. However, the total transition is taking more time than what we had budgeted for. The distribution initiative, while the correct one for long-term sustainability of the business, is causing some temporary pain. Our growth objectives, as guided earlier for the first half, was not met. Revenue growth was at 2.4%, against our target of high single digit. We are recalibrating our target for the second half, in particular the third quarter. Once again, I reiterate that we are on the right track and we had to necessarily take this journey as the earlier route to market was not upgraded in over 2 decades. My management team and I are confident that we will have every last wrinkle out of the way in the course of the next few months of the current financial year. Let me now get to the specifics of our 3 business categories. While continuing to focus on our traditional carbon zinc batteries, the quarter saw our launch of the latest technology Ultima Pro batteries in the premium end of the market. Our communication with the launch of this high technology premium range captures key product attributes while conveying the essence of the Eveready brand. During the quarter, we saw a handsome jump of volumes in our latest offering of this premium portfolio, with growth moving ahead of the market trend. On the cost front, the industry is benefiting from lower raw material prices and stability in exchange rates. As a result, there has been a marked improvement on the margin front of the battery business unit, despite a higher charge on account of A&P. The overall battery revenue for the half year remained flat due to constrained purchasing by trade following the RTM revamp, as explained in my remarks earlier, which will normalize in the coming months. However, due to good movement of our secondary and tertiary sales, we maintained our market share in batteries at 53% plus as per the latest Nielsen report. Now I come to flashlights. Flashlights has seen interesting SKU introductions from us in the growing rechargeable category. We believe that our offering provides the right quality product and a feature value proposition. As mentioned in our earlier calls, we made a late entry to this segment of torch market with a view to protect our traditional but regrowing battery operated torches. The market is rife with innumerable offerings from unorganized players at very low price points with larger than reality promises. While the consumers eventually get disappointed with such products, it is still a task for organized players given an already established pattern of rural consumers downtrading in the recent times. However, we remain confident that with our superior product proposition, we will be able to secure a healthy share of the market. While we are receiving a reasonable traction for our range of rechargeable torches, the battery operated torch market is degrowing faster than our earlier estimates. Combined with delayed and erratic monsoon in parts of the relevant geography, the uptake of flashlights was slow in the rural segment during the quarter. As a consequence of this, our flashlight revenues remain flattish. I shall turn my attention to our LED lighting business. We have seen a sharp value degrowth in the market triggered by lower cost of production, which the players passed on. The degrowth for the market is estimated at upwards of 10%. We, however, managed a growth of 8.4% over the half year, which we believe to be a reasonable achievement. Historically, this market has seen healthy growth, the volumes remain strong, and it is expected that the present value degrowth on account of pricing initiatives is temporary. Thus, the market is expected to return to its usual buoyancy within a short span of time. Our teams have made good inroads both with the exclusive electrical outlets as well as in the general trade. Over time, we have also worked upon getting a portfolio suitable for the market, and now we have an extensive range of offering, including the segment of emergency lamps, in which we are one of the leaders in the market. We continue to remain optimistic of growth in this category. I shall now share some key aspects of our performance during the second quarter. The company reported flattish revenue due to reasons already explained in my earlier comments, namely challenges emanating from the restructuring of the RTM, a faster degrowth of the battery-operated flashlights, a slower than estimated pickup of the rechargeable flashlight segment, and an overall value degrowth of the lighting market. On the profitability front, however, there is growth to report. EBITDA came in at rupees 46.3 crores, giving us a margin of 12.7% relative to a rupees 43 crores and 11.4% margin in the second quarter of the last year. Favorable trends in key raw materials and stability in exchange rate aided the margin performance, which came in despite moderated revenue and higher A&P spends. We are not taking our pedal off the accelerator yet for A&P spends, and some of the margin benefits are getting duly plowed back in the business. The company reported a PAT of rupees 25.5 crore for the second quarter, with 74% growth over the same quarter of the previous year. I will now summarize our position as we stand today. The current quarter's revenue was muted, but the assignable causes are identified and countermeasures are in place. Our financial performance has been significantly better than our expectations. We have made investments both in the brand and the distribution infrastructure. We have brought new product offerings to the market with our latest generation battery products, the feature-laden rechargeable flashlights, and the robust portfolio of lighting products. We believe that we have worked on all areas which provide a healthy path to sustainable growth. The third quarter will still be muted, but hopefully thereafter we shall start deriving benefits from our transformational efforts. In the overall, we believe that our journey remains meaningful and we will push ourselves for faster improvements. I conclude my remarks here and will now request the moderator to open the forum for question and answer.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may please press star and one to ask questions. The first question is from the line of Nirav Siksaria from Living Root Analytics. Please go ahead.
Hello.
Yes,
Hi,
sir.
am I audible?
Yes, you are.
So I just wanted to know that does the new promoter have some board representation, and does the new promoter have the representation in the management?
Okay, so first of all, the new promoter is incidentally more than 1 year old. So I don't know whether that classifies as new. Yes, the promoter has representation in the board. He has no representation in the management.
Okay.
So hi, I'm Nirav's colleague. So I had one question. We were previously investors in Eveready about some 7-8 years back. At that time, of course, under the previous management, Mr. Khaitan, you had launched the LED and you had launched some small consumer appliances as well. So I believe you made a decision to move out of the small consumer appliances. But going ahead, sir, what is the idea as in, an investor entering today into Eveready? What should be the expectation from an investor point of view, as in the company will be focusing on what? Because we all understand the brand story and the distribution story very well. That, you have distribution across so many outlets, and Eveready brand itself is an enduring brand which has been around for few decades. So if you can just help me with the, what is the target in terms of revenue and which areas are we going to focus on?
Sure, Nirav. So, yeah, I confirm that we have moved out of the appliances category altogether. That the journey, we completed sometime early last year. With regard to LED lighting, this happens to be our, I would say, a very important part of our business on which we are banking for growth. So, our brand and distribution is highly synergic to the category. General, and it is some, I would say, brand is of course there. The distribution is kind of unique. Apart from Wipro, no other company, because Wipro also has an FMCG business, no other company has the kind of, footfall in the retail outlets, in the Kirana outlets that as we have. So that is one unique proposition we bring and would be, sort of a platform for growth in this part of the business. Apart from that, we also have, today a separate channel which is currently focusing only on the exclusive lighting outlets. So, we have on the distribution side and also helped by the latest revamp of the RTM that I mentioned in my remarks earlier, I think we are quite uniquely positioned to leverage the entire distribution system of Eveready. Okay, we have already talked of the brand, so I'm not going into that anymore. What else was required was to develop a very robust portfolio of products that is, not only relevant for the Kirana stores, which is naturally the lower end of the product spectrum, which are lamps, battens, etc., but even going higher end, with downlighters, panels, etc., etc. So we have developed that entire, and I must not forget to mention the emergency lamps, which go both in the electrical outlets as well as the Kirana outlets. So we have got a very robust portfolio today, very wide, and so I think we are uniquely positioned to get leverage out of this segment, and it remains a huge cornerstone of future growth potential.
Right. So, sir, which geographies will you be focusing on with the LED portfolio? I mean, apart from the lights, you said downlighters and other stuff, also hanging lights. So which areas?
It is like this. Eveready has been, for whatever our size of turnover, has always been pan-India. There is no region preference. We are absolutely all over the country, and for our lighting business also, we will follow the same model.
Okay. So right now, lighting business is what percentage of the revenue? Because I don't think
the lighting business is about 22%, and we hope to, grow it to something like 35-40% in the course of the next 3-4 years. That is our aim.
Okay, and lastly, last question, in terms of the battery business, has it seen any growth? In terms of...
Sorry, just come again?
I'm saying last question, in terms of the battery business, has the battery business seen robust growth? I mean, is that seeing robust growth in terms of volume?
Traditionally, has been growing at, I would say, mid-single digit. But the growth is not, extremely high or any such thing, but it is a very steady kind of growth. So we flow with that kind of growth most of the times. That is what explains our steady market share over, several years, and certainly the last few quarters. And as I have been mentioning in my calls earlier, that there is a potential for growth, once new devices come into the country, but that is as and when it comes. At this point of time,
so this growth is from pricing growth or revenue growth?
So it is a combination of both pricing and volume. Yeah. So typically, I would say the total industry market would grow by 6 to 7%, of which volume would be about 2-3%, and balance would be pricing.
Okay. Thank you, sir. Thank you so much.
No problem.
Thank you. The next question is from the line of Aditya Makaria from HDFC. Please go ahead.
Yeah. Hi, sir. Firstly, can you give us an update on the case, on the ongoing matter with KKR? Is a resolution expected anytime soon? Because, sir, this is preventing us from infusing fresh capital in the business, and hence our foray into newer categories is being constrained because of this matter, which now I think is over 12 or 15 months, some such a long time frame.
So Aditya, this particular case proceeding is in the arbitration court, which has given kind of final date for coming out with a decision towards the early part of 2024. So we have to wait for that time frame for the decision to come out.
Okay, fine. Okay. Second is on the lighting business. Do you think we have miscalculated the growth potential of this business? Because, despite us having a 2 or 3 or maybe sub 5% market share, we are clearly not seeing the kind of growth which, early entrants should see. I mean, with our brand and distribution, we should ideally be scaling up much faster. So do you think that there is something we have miscalculated in the way the lighting business dynamics are?
Sorry, I have to disagree with you there with your conclusion. As I mentioned in my remarks, I first speak of this year, this financial year, the first half that we have gone by. You see the results of all leading lighting companies, they are all in serious degrowth. I don't want to name the companies, but they are in, I would say, a high single digit degrowth. The market overall is degrowing by more than 10%. In that, we have grown by 8.6%. So, I would not agree with the point that we are miscalculating our growth potential. I think we are growing very handsomely. Last year, we grew by something like 25%, which again, I think was much higher than the market level of growth. So, as you rightly said, maybe some of these higher growth momentum is coming to us because we are still a relatively smaller player, and as we scale up, obviously the growth percentage will come down, but to get back to the main point, we are growing very handsomely compared relative to the market.
Okay, so when you were referring to route to market, which led to change in your distribution strategy, that was for which particular segment, sir?
It was for the whole company's distribution system, which encompasses both general trade as well as electrical trade.
Okay, so we are continuing to revamp our electrical distribution network, because I thought we were pretty much through with that last year, right? Because we have...
No. We completed that. The implementation in terms of, execution steps got completed sometime in March, which was FY23, but the impact of the changes, etc., were more prominently felt post that, which were the first 2 quarters. And again, we are still continuing with some of the finishing work in this quarter, in the 3rd quarter.
Okay, got you. So just last thing, you said you grew 8.5% in lighting in the second half, in the 2nd quarter. So
First half.
Okay, first half. Okay, so then batteries is what is, batteries and the flashlights is what has led to the lower revenue.
Yeah, both were flat.
Got it, okay. Thank you, sir. Wish you all the best.
Thank you, Aditya.
Yeah.
Thank you. We'll take the next question from the line of Rishabh Somani from Earth Ventures. Please go ahead.
Hi, good afternoon, sir, and thank you for the opportunity to lead the discussion. I wanted to ask you regarding your top line and bottom line. So in this quarter, you've done 365 crores, which is lesser than last year this quarter, so 375, but your profit is still higher. It's 25 crores versus 16. So can you shed some light on what's driving this increase in the bottom line despite the contraction in the top line?
Thank you. Vivek, would you like to take that?
Yeah, sure. Thank you for this question. As Subhoma has explained about the complete segment-wise revenue, that where do we stand. Major reason of our profit expansion is basically, the softening the raw material prices. So the zinc is a key raw material for our battery product, where there is a softening of the prices of the zinc, and which has led to our gross margin expansion following the bottom line increase for operating margin. And from the below the operating margin to the PAT level, if you see our bank charges, last year there is a one-time amortization charges of some upfront fees, and this year it is not there. So these are the two major reasons whereby despite we are holding the flat revenue, our bottom line and PAT has expanded.
Thank you, sir. I also noticed that there's a new line item in your balance sheet for intangible assets under development. So can you shed some light on that as well?
What do you see?
Intangible
so these are basically some software. This is basically mostly some software because we have got into SAP implementation in the company. Okay. So SAP, and we have taken a Salesforce automation called a BIZOM. So these works are under progress. Once this is gets completed, it will convert it to the intangible assets.
All right. And in terms of the sale of PP&E, what asset did we sell this quarter?
Pardon? Can you repeat the question?
On the cash flow statement, we can see some proceeds from sale of PP&E. So what equipment or plant were we selling? Did we sell this half?
Just give me a second. This could be a normal sales. Just allow me a moment, please.
Of course.
In the meantime, if you have any other questions, so in the meantime, I'll get this. No.
Okay, yes. The last question I had was regarding the net cash generated from operating activities. Yes. So this half, it's almost 100 crores compared to 17 crores for last year. So what has changed is it all led by the softening of the raw material costs, or what is causing this 80 crore increase in operating activities?
So this is mostly because of the profit has increased, and there was a last time one-time charge was there, which is not there. So, and if you see our working capital also last year, it was disproportionately high, around 70 crores or there increase. This year we have managed to manage our working capital also. This all has led to our better cash flow, operating cash flow position.
All right. Thank you.
I will get back to you just a moment, okay, in the meantime. So we'll get you connected. A particular point on that, I will get you.
Thank you, sir. The next question is from the line of Dhruv. Before we take the next question, a reminder to all the participants, anyone who wishes to ask questions may please press star and 1 now. The next question is from the line of Dhruv from Ambit Capital. Please go ahead.
Hi team, had a couple of questions. So just wanted to understand, where do our margins start to peak out? So we've seen a fairly decent, 2-year journey with respect to margin expansion. But when do you see your margins hitting a peak, and if you can give a color on that, and in what range it could be?
So let's give you with respect to, let's talk about a gross margin, which I'm talking about. Because of the zinc price reductions, we have got approximately 300% our gross margin, 300 bps our margin got improved. So, and consequently it flows to our bottom line. So as our aspiration is always go to a mid-teen level of operating margin, and which we are still holding. And as we have spoken about that the current year, we are looking for a double-digit operating margin to start with against 8.4% of the last year. So still we are holding on that.
Okay. We've seen a slightly higher capex in the first half. So just wanted to understand that.
So there are some technology investment going on in the company. We are implementing SAP, and we are implementing some software which I've just now spoken about. So that is one of the major investment going at this point of time. And we have given advances for some machineries and all. So that is the way. So that investment looks like, it will be equalized maybe over a period of time.
Okay. And Mr. Saha spoke about the RTM changes per se, right? And we wanted to understand that when do these changes, get normalized and growth really starts to kick in? Will we see it starting from Q4 or the next full year? And I wanted to get an update if that Bain project, when does that end? Because if I'm not wrong, your other expenses are slightly bloated because of that.
So, Dhruv, let me take this one. As I mentioned that, the RTM execution steps were completed sometime in March. But the first 2 quarters, we had to sort of contend with, the changed scenario, which included, ourselves also getting attuned to that, getting our channel partners, sort of aligned to that, and that has spilled over even to the 3rd quarter. We feel that, it is very difficult to say whether it will take 2 or 3 more months, but certainly within this year, we will get all that sorted out. And I think we should be back to our growth momentum certainly from 1st quarter of the next financial year, if not 4th quarter of this year. But 3rd quarter will be muted, as I already have indicated.
And so the Bain project?
The Bain project is now completed as of this 15th of this month.
Okay. And sir, if I may just even one data question, so if you could just share the revenue and the EBITDA of different verticals, that would be great. Thanks.
So in this quarter, Vivek, could you like to answer that?
Sure, I'll do that. So in this quarter, our revenue from batteries is holding around 246 crore, flashlight 42 crore, and lighting is 85 crore. Okay, that is with respect to our profitable revenue, and with respect to battery as overall profitability, batteries are holding around 46 crore operating margin, 47 crore, flashlight 4 crore rupees, and lighting is around 4 crore negative.
Thanks a lot. I wish you all the best.
And just to answer one question has been asked in between, there's about the proceeds from the sale of assets. It is actually a 20 lakh rupees, mainly sold our old cars. So there are a lot of pool cars were there, and we have actually liquidated those sales, and that is mostly from that.
Thank you, sir. The next question is from the line of Arnav B, an individual investor. And may I request the participants to please press star and 1 to ask further questions.
This is proceeds from sale.
Please go ahead.
Thank you. My first question is, I would like to know what is the time lag between tertiary sale to primary sale for Eveready in normal time and in these challenging times because of new route to market? That's my first question. The second question is,
could you please repeat your question? I didn't understand that. What is the time lag between what?
Yeah. See, in the last quarterly call, I remember discussing this point that the tertiary sale had shown a jump. And with some time lag, sooner or later, it will also show up in the sale of Eveready's primary sale. Now, obviously, I understand that because of this RTM, new route to market, it didn't reflect the growth in tertiary sale that you have seen is probably not reflecting. Either my understanding is wrong or there is a general time lag, and right now, because of new route to market, the time lag is longer. Or maybe this is not the right way to interpret how soon the tertiary sale growth in case of battery could be reflected in Eveready's primary sale numbers. Is that a right way to interpret it, or am I reading it?
So let me try to answer your question, and then you tell me if I have been able to clarify properly. See, normally primary sale to secondary sale to tertiary sale, there is very little time lag. The whole process is determined by tertiary sale. Because the consumer buys something, that gets demanded from the distributors. And then in turn, the distributor makes an order and requisitions that stock from the company, right? Ideally, the time lag, even realistically, the time lag is quite minimal. But what happens sometimes, as it has happened in our case, due to the RTM, revamp, there were islands of, overstocking, understocking, etc., which disrupted this flow a little bit. As a result, while tertiaries continue to be strong, and obviously the tertiary is being fed by the secondary channels, it didn't finally result in a primary sale. And that got manifested in primary sale showing flat, because we only record the primary sale. We do not record thereafter. We track secondary sale, we track tertiary sale, but we do not record. What is recorded is what we sell to our distributors. So again, to come back to your question, there is really hardly any time lag.
Got it, sir. That totally clarifies my first question. I'll just take another question. Again, for last couple of quarters, management is guiding that whole year operating margin would be in double digit, right? Now, obviously, so far it has exceeded that and everything is great, operating margin wise. But historically, we have seen that the fourth quarter rarely, at least last time, we barely break even, right, operationally. And I suspect sales are generally lower in the fourth quarter because of seasonality factor. However, you would not probably reduce your advertising and promotional spends. So chances are we would barely break even. So with that, do you still foresee operationally as a whole year basis you would do double digit OPM?
Yes,
so I'll take this.
Yeah, please, go ahead.
So I'll take this answer. You are absolutely right. But we also learn from how things are going on. As of now, you are seeing that above 12% gross margin we are sitting, and our first half is always higher than the second half. So we are very conscious about that, and we are constantly monitoring. Last year itself, we have started advertising. Before that, earlier we are not doing. So we have taken account of that, and still we believe that the way we are focused on our margin expansion with the growth ambitions and cash flow generation. So we still hold that by the year end we'll be able to get to the double digit.
Excellent, sir. Thank you very much, and all the best.
Thank you.
Thank you.
Thank you. Participants, you may please press star and 1 to ask questions at this time. The next question is from the line of Alisha Mahavla from Envision Capital. Please go ahead.
Hi, sir. Good evening. So just wanted to check this change in distribution network and route to market, which, like you said, you all are working on ironing out. Is this largely complete, or what is the time frame when we expect that the challenges that we're facing, we will be able to overcome them?
Alisha, I had explained in my earlier remarks and also in the answer to one of the questions. We completed execution steps on the RTM in March of this year. In the quarters thereafter, namely the first and the second quarter, and even in the current quarter, we are having to sort of realign ourselves, the whole channel structure and ourselves internally into this new, sort of kind of structure that we have built. And we don't think that it will take us too many months ahead to get all the fixes. And we are quite confident that certainly by the end of this year, the RTM chapter would become completely stabilized.
Okay. No, while I did get that, I was just trying to understand, one, what's the kind of challenges we're facing, and two, a separate question. Will it be possible for you to share what is the current distribution network that we have? What was it earlier, and post this change, where it is?
Yeah, I'll certainly do that. So, we were working with 5,000 distributors at one point of time. With the size of our turnover, the 5,000 number was certainly too excessive. And as a result, the company was actually trying to service, say, remote areas directly where the service efficiency was simply lacking. Even in the larger towns, we had far too many distributors, dividing the business among themselves, and did not make much business sense for them to be, being totally engaged in that kind of small turnover. So what we have done is we have brought that number down from 5,000 to 1,000. So this has given rise to a lot of consolidation in the main towns, meaning, say, our town had 8 distributors. We have cut that down to, say, 2 or 3 or 4. And then we have replaced that entire small dealer network that we had in the rural side, or the, let us say, in the remote areas, by a super sub infrastructure, where the super has now become the distributor directly with the company, and all those small dealers have become his sub dealer. Now this has meant, where did the challenge lie? The challenge lies in pruning that number down to 1,000 from 5,000, meant selection, bringing some new people, changing some people, etc., etc. There is a human element to it, and also, issues relating to working with new partners, people working with new enhanced territories, enlarged territories. So these lead to some amount of, I would say, gaps, and with many of those, they have gone very smooth. With some of them, we have found a little bit of challenge, which we are ironing out. So as I said, the first 2 quarters we did that, and so at the end of the first half, we had a revenue growth of 2.5%. This quarter and the second quarter was flat. This quarter is also going to be muted, but I think we will see positive development from the fourth quarter. Have I answered your question?
Yes, perfectly. Thank you. So my next question is on the A&P spend. I believe we were mentioning earlier that we believe this is, or rather, we would want the number to be between 7 to 8% of revenue. But earlier in the call, we did mention that we've done a little bit of rebranding and introduced new campaigns also. What was the ad spend during this quarter, and where do we expect it to be next to?
So this quarter we went to something like 12% of the revenue. That was because this quarter was when we launched our Ultima and Ultima Pro, the latest technology, new generation batteries, which was addressing the premium segment. That was sort of accompanied by quite visible campaign both on TV as well as in other media, which is why the percentage-wise the cost shot up. But that will normalize in the next 2 quarters. That will normalize. We are guiding. We have said this earlier. We would come down perhaps this year to a 10% kind of level, and then maybe in the following years we would, as turnover increases, maybe we would go down to something like 8, 8.5, 7, something like that.
Got it. And just one last question: any revenue aspiration that you would like to share for next year, or maybe for the 3 to 5 year goal that we may have?
No, so we have all along said that this company is currently pivoting its existence on growth, but for whatever that we have discussed and explained during this call, we have gone into a situation where we have not been able to meet that aspiration. We would certainly like to go back to that double-digit growth aspiration for the next financial year. So that is the guidance at this point of time. We cannot give you an exact number just at this point because there are variables which we need to figure out, but certainly a double-digit growth would be something that the management team would certainly chase.
Okay, great. Best of luck. Thank you.
Thank you, Alicia.
Thank you. Participants who wishes to ask questions may please press star and 1 at this time. Ladies and gentlemen, so we have one question in the queue. We'll take the next question from the line of Rishabh Somani from Earth Ventures. Please go ahead.
Hello again, and thank you for answering my question regarding the sale of PP&E, sir. I wanted to ask you regarding any debt guidance that Eveready is having right now.
So, as we know that, we have started the year with more than 357 crore of debt. I'm happy to say that, during this quarter, we have reduced the debt by more than 53 crore and our net debt stood at 350 odd crore.
Excuse me, sir, I'm sorry to interrupt, sir. Your voice is muffled. I would request you to kindly repeat your answer, please.
Okay. So, can you hear me clearly?
Yes, sir.
Yes.
This is much better.
Okay. So, at the beginning of the year, our total net debt was 367 crore. And happy to say in the first half, we have reduced the debt by more than 53 crore. So, now our net debt is stood at 314 crore during this whole half year. And so, we look forward to the year definitely to go less than 300 crore and depending on the business requirement. So, the debt reduction journey will continue because always we would like to have a lesser debt for us. And that's the way we stand today.
So are we planning on making it debt free essentially over the coming years?
Yeah, of course, yes, yeah. So our aspiration has to be next 2 to 3 years, the company should go for a debt-free company. There is no reason for a company who is holding the highest market share, 53% plus market share, to have any debt in the market. So we are really working towards that. And if you see today also, we are holding the highest market share in the company despite of revenue flattening. And we are continuously doing this debt reduction quarter by quarter. First quarter we did more than 25 crore. Second quarter also we have done a 25 crore plus debt reduction. And we believe that the journey should continue.
Okay, thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you everyone for taking out the time to join us on this earnings call today. I hope we have adequately answered all your questions. If you still have any more queries, please reach out to our investor relations team and we'll be happy to address them. We endeavor to interact with all of you every quarter through this forum. Thank you once again and look forward to connecting again in the next quarter.
Thank you, members of the management. Ladies and gentlemen, on behalf of Eveready Industries India Limited, that concludes this conference. We thank you for joining us and you may now disconnect your lines. Thank you.